Good morning. Welcome to Stock Market Today. It's Monday, September 28th, 2020. This is your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. You can find me on Twitter. I'm at Dan_Russo_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today. Sign up for a free email where I get a lot of the great content for this show. We also give you daily stock ideas to consider, and that hits your inbox every trading day before the market opens. So U.S. equities were higher in Friday's trading, though the S&P 500 did post its fourth straight weekly drop. Most sectors were higher, led by tech, REITs, and healthcare. Materials and consumer staples underperformed. Energy was the only sector to finish lower, and energy is just, we've been pounding the table bearish on energy for over a year now. So anybody who's bottom fishing in energy, I question, I ask you, what are you doing? Maybe the sentiment is so washed out that it makes sense to look, but until the trend changes, I can't get there. But it's also not my style. It's not my game. Treasuries were unchanged and continue to trade in a tight range. Dollar was higher on the major crosses. And as I've said last week, I think the dollar is arguably the most important chart in the market right now. You may not trade currencies, you might not care, but even if all you do is look at equities, you have to be paying attention to the dollar at this point. Gold was down 60 basis points. Oil was lower. WTI crude down 10 basis points on the day. As we get to the desk this morning, S&P futures are continuing to rebound, higher by about 90 basis points here in the early going. Overnight, Asian equities were higher, with Japan, South Korea, and Hong Kong all gaining more than 1%. China, though, was slightly lower. European markets are rallying. Actually, bank stocks are the best performers. We haven't been able to talk about European banks in a positive way in a long time. It's actually one of the charts that I pay close attention to. Treasuries are unchanged to slightly weaker. The dollar is weaker on the majors. Gold down 50 basis points. Gold got hammered last week, down nearly 5%. We'll look at the gold chart, fell out of the consolidation, and you had a clear trigger to get out of the way if you've been bullish gold for a trade. WTI crude is off 90 basis points after being down about 2.5% last week. So let's dive into the commentary and see what's going on. Major averages here. S&P 500 trading back above 3250. So we have near-term upside to the 340 level, 3400, and that's the higher probability event as far as I'm concerned. The Qs closed back above 270 for the first time in a while. This chart did not update, but the Qs closed back above 270, and that's important. IWM still below the 150 level. It's the last holdout, so that's the one that we're watching very closely. Let's hit our market in a minute, though. What are we writing about in the note today to Chaikin Analytics clients? Well, SPY and QQQ retake key levels. We've talked about them. SPY, it's 325. QQQ, it is 270. Those are the levels, right? Those are your trigger points where you say, if we're above these levels, odds favor upside. If we're below these levels, odds favor downside, right? When we talk about the framework, the map, thinking about probabilities and odds, those are the levels that you're watching. We'd love to see IWM get back above 150. That would be a positive breath confirmation and provide an upside kicker. Gold, on the other hand, did lose a key level, right? Gold's been in a consolidation since the end of July. For those of you who are, into the chart patterns, you could call that consolidation a descending triangle. I mean, I am a technician. I'm not into the patterns. They're way too subjective for me. But I do, you can identify support and resistance in a quantitative way and see when they break. And that certainly has happened here with gold. Dollar remains a key to risk assets, right? So gold broke down as the dollar broke out. That inverse correlation, well understood. However, the inverse correlation really extends across risk assets, and that's been in place since March. So to the extent that the dollar continues to rally, Dixie, UUP, whatever your proxy for the dollar, you're going to have to remain somewhat nimble and cautious in risk assets. And you can see dollars down this morning, futures are rallying. Rates remain in tight ranges as treasuries move sideways. Futures point to a higher open today. Let's hit the power bars now. Deterioration, certainly the name of the game last week, but some stabilization towards the Friday timeframe. Dow up 1.3%, 4 to 8 bulls to bears. S&P up 1.6%. We have a draw there, 105 to 105 bulls to bears. NASDAQ still skewed in favor of the bulls, 20 to 12 after massively outperforming on the day Friday. Remember, not this past Friday, but the Friday before that, we meaning Chaikin Analytics and myself, started talking about growth reasserting, continuing to play out. So feel like we're on the right side of that one. Early developments confirm that we are on the right side of that one. So let's continue to watch that one play out. Small caps, I'm not interested on a relative basis. For me, though, it's not so much that small caps have to outperform. I just want them to get in gear. If they get in gear, it lends a breath confirmation. If they start to outperform, we'll pay closer attention to them. 450 to 350, bulls to bears there. Bonds unchanged. Tech, your outperformer. One more positive data point for the reassertion of the growth theme that we've been talking about now for over a week. 15 to 8, bulls to bears in that camp. Let's hit our stock of the day. Our stock of the day is Dick's Sporting Goods. And we've started to see pockets of strength within consumer discretionary away from Amazon, and that's what's important to me. The simple fact of the matter is Amazon is 25% of discretionary. So if Amazon's doing well, you have to drill down and say, well, what does the rest of discretionary look like? But what's interesting is as the growth stocks were slumping before starting to reassert on our call last week, discretionary actually was doing well, was holding up without Amazon. That makes me sit up and take notice. I want to know who the leaders are in that group, and I want to start paying attention to those leaders, and I want to start looking for opportunities in those leaders when they present themselves, and Dick's is beginning to. Dick's Sporting Goods, very bullish rating, strong trend, strong industry group. Now, what I will say is it's probably a little early. So are you aggressive? Are you conservative? That should drive you here. Our overbought, oversold indicator, I dropped down our checklist, is just entering an oversold condition, right? So if you're aggressive, you can take it. If you're more conservative, you're waiting for the indicator to maybe start to round higher, recognizing you may pay up. But that's okay because you're conservative, right? You're waiting for that extra level of confirmation, right? I think of the checklist here as the what in the top, the when in the bottom, certainly the type of name we want to own. The when is it maybe a little bit early for more conservative investors, more aggressive investors. It looks good. I think you have price-based support at $50. You're above a rising trend line. You have bullish money flow. I like Dick's here. Trend strong, industry strong, sector strong. I think it makes sense to be paying attention to a name like this. And to be perfectly honest, I go there a lot. I think it's for traditional retail, I think it's a fairly good experience. I think the service there is great. I think the quality of the product is really good and what they offer. So, okay, let's line it up. This looks compelling to me. Dick's, stock of the day today. Our sector tracker now, movement over the last 5 days from the major sectors. Tech is at the top of the list, so lining up with our views. Utilities, bullish, discretionary. We were just talking about discretionary, weren't we? Also positive over the last 5 days. Middle of the road, comp, staples, healthcare, and REITs. Bottom of the list, industrials, fins, materials, and energy. Now, materials are interesting because that's our favorite cyclical sector, right? And it's come under pressure. Some profit taking in the near term, but there's that dollar trade. So would we start writing last week? If the dollar continues to strengthen, we have to kind of become less aggressive. We reevaluate that view on materials. That's what we're doing now, okay? I'm still watching it. I still think it's interesting. I still like exposure. But it's, we're paying attention. Energy, I don't know what else to say. There's nothing to say. Maybe when we eventually everybody just completely stops talking about it, that's when it could rally. I don't know, but it's a disaster. There's no two ways about it. And I have a really interesting chart at the end of this presentation. Our industry in focus, space and defense, which is obviously going to be a hot button industry leading into the election. It's been an underperformer over the past 6 months, lagging by about 8.5%. And power bar ratio here is weak. 9 bulls, 4 bears. That hints at future potential. So names we want to avoid: Axon, AeroVironment, AVAV, and Northrop NOC. All with very bearish Chaikin power gauge ratings that are holdings in a fund that has a bearish ETF rating. Check out XAR. Bearish rating, weak trend, right? weak power bar ratio, this chart looks gross. All right, that's a technical term, gross. And it's what describes this chart. I mean, it's angry looking since March. Look at all the red. Look at all the red, and just, do you want to own this? Does this look like something you want to own? Or would you rather own the software stocks that we showed you last week? Would you rather own tech in general that we started talking about a week and a half ago as putting in a solid level to bounce from? Find the relative strength. It's crazy to be sitting here messing around in these beaten down, underperforming areas. They'll turn. If they turn, you'll catch it. You're going to catch the bottom? No. But trying to catch the bottom, you're going to end up with a lot of knives going through your hands. It's ugly. Let's look at what's trending now. Winter side of the board has a theme. Barclays upgraded the cruise lines. Norwegian, Carnival, and Royal all trading higher on Friday. WRK, I didn't see anything company specific to drive trading there. Boeing got an Air Force contract, send that stock higher by 6.8%. Loser side of the board all has something in common. You should be able to see it, but if you can't, energy. Only group lower on the day Friday. Utter disaster of a sector. Again, why do you want to play there? I don't know. Maybe if you want to be early on a washed out trade and you have the time and the patience and the stomach for it, great. Me personally, I'd rather wait for the trend to turn and then get there, because I do think it'll be interesting when and if it turns, because it's so small now that nobody's really paying attention to it. Nobody cares. So you can get massive alpha when this turns because nobody cares. And it'll be a while before people do. So if you recognize the turn early, I think there's opportunity there for alpha. Let's talk about the charts now. Gold falls out of the consolidation. There it is, plain as day. You have your triangle after a breakout. So breakout, run, consolidate, breaking back down. To me, the breakout level is 1800. That's the level I'm watching on a fall, right? If we think about wanting to buy something, buy a pullback, buy something that is still in an uptrend and getting to a level where we think it makes sense, I think 1800 on gold. Now, that could change, right? Buyers could step in. Everybody can see this 1800 level. It's plain as day. So maybe we start to see buyers ahead of that, in which case we'll look for stabilization and an uptick. What's interesting to me is the RSI has not become oversold. But this is all playing out as the dollar at the bottom of the screen has broken the downtrend and broken topside through the consolidation that's been in place since August. So if we get some dollar weakness and gold stabilization, it might look interesting. Otherwise, I think, getting closer to that 1800 level makes sense for the gold trade. Other commodities, we've liked the ags, right? And as a function of that, we've liked chemical stocks, especially names like Mosaic, which we talked about last week. Fertilizer play on ags. Now, ags have gone sideways here. They're holding the 200-day moving average above the 50-day moving average, so far holding the breakout level. RSI still in bullish ranges for DBA. It's the agricultural ETF. While relative to broader commodities, DBA relative to DBC looks to be in this rounding pattern. So we'd look for a breakout here. So this group still looks somewhat interesting to me. Admittedly, trying my patience. I've liked agribusiness, MOO. I've liked names in the group like Mosaic. I've liked ag commodities. It's trying my patience. There's no two ways about it. But I'm giving it the benefit of the doubt for now, but we'll continue to monitor it and watch it closely. I do think it's interesting. I do think it does provide a level of diversification away from some of the more crowded areas of the market, but those crowded areas have now become less crowded, and I'm focusing back in the growth theme again, as I've been talking about on this show for over a week. And then finally, I said there's an interesting chart, and this is why I believe in innovation, and I believe in the team at ARK when they say innovation should be its own asset class. This is the TAN ETF, solar ETF relative to the XLE, the energy ETF, and pretty telling. Don't fight innovation. The trend is well established. I do think innovation should be its own asset class. I agree with the team at ARK. And that'll wrap us up for today. Have a great Monday, everyone.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're going to bring you daily content from an incredible collection of technical analysts and financial experts.